We move on. So that was the fund in focus, but then let's talk about loan borrowers. Now, loan borrowers are all for lesser home loan interest, but this rate has just got extended. But that being said, loan borrowers are also concerned and confused about the benchmark rates with which their loan is actually attached. Now, we're talking about external benchmark lending rate and marginal cost of fund based lending rate. And to understand the difference between the two and how would each benchmark loan borrower benefit, I have with me A R Hemant, Head of Communications, BankBazaar. Hemant, good evening and welcome to the show. A very basic discussion that we are seeing that's happening a lot on social media, also the difference between MCLR and EBLR. So just to give a basic understanding, what exactly is the external benchmark lending rate?
Good evening, Kavita. Thanks for having me here. So, before I answer that question, just give me a moment to explain the concept of benchmark rates and spreads. So, basically, your home loan agreement, it would have two things mentioned clearly. One is the benchmark rate and then the spread. The benchmark rate is the lowest rate at which that loan can be given, and no bank will lend below that rate. And the spread, which the banks can charge over and above the benchmark rate, is primarily decided by factors such as the borrower's income, credit score, size of the loan, and to a lesser extent by whether you're a man or a woman, where you work, and whether you're taking a new loan or refinancing an old loan. So, to give you an example, the preferred benchmark rate today is the repo rate. The repo rate is at 6.5. And we have one bank giving a home loan spread of 2 percentage points. So the final rate is repo plus spread, which is 6.5 plus 2, which is 8.5. So that's the lowest lending rates we are seeing in the markets right now. Now, what is the difference between MCLR and EBLR? Basically, these are MCLR is the old benchmark and EBLR is the now the prevalent benchmark in the market. MCLR is the RBI mandated benchmark between 2016 and 2019. And since October 2019, banks have moved on to EBLR. They had the option of picking the repo rate or the treasury bill yields. And the vast majority of them chose to benchmark their home loan rates to the repo rate. So that is where we are right now. Now, the key differences between MCLR and EBLR would be that, there's a reason why the RBI has mandated these changes over the years from MCLR to EBLR now, and before MCLR there was also base rate and BPLR, and the constant refrain that RBI had was that the policy rates are not being transmitted to borrowers, and that keeps the interest rates higher than they need to be. So that is why we have transitioned from one benchmark to another, and finally we are at EBLR. And the benefit of EBLR today is that whenever the repo rate changes, within a span of 3 months, your interest rate, your home loan interest rate will reset automatically, whether it's falling or rising. It works both ways. Whereas what we have seen with the older benchmarks is that rates may rise rapidly along with rising inflation or the rising repo rate, but they tend to fall much slower than those things. Whereas with EBLR, it cuts both ways. It will rise rapidly, it will fall rapidly. So that is where we are right now. And most of the market right now.
Right. So this is one thing that I think we should be focusing on as to why the old rates would go down slowly as compared to external benchmark lending rates. So what's the calculation and what's the maths there, Hemant?
So MCLR is an internal benchmark rate, which is decided by the banks basis the cost of their funds. So if the cost of the funds are rising, they will pass on the cost of the funds to the borrower, right? That is why interest rates will go up regardless of the repo rate going up or down. And with repo rate, it's an external benchmark. It is controlled by the RBI. So your loan, if it is linked to the repo rate, it will change only when the repo rate is changing. So that is the key difference. And the RBI has also mandated that these rate changes need to happen at least once a quarter. So there is a lot of predictability in terms of what is going to happen to your rate. So earlier you were not clear by how much your rate was going to change and when. With MCLR, the when part of the problem was solved, because then that your rate is going to adjust once in 6 months or once in 12 months. With EBLR, the how much part of the problem has also been solved. You know how much your rate is going to change and when. And that is what has changed over the last 4 years.
All right. So can we say that most of these banks and most of these home loans are now attached with EBLR?
according to the RBI, almost 50% of outstanding floating rate loans were linked to the EBLR. About 45% were linked to the MCLR. Now, there's one interesting trend going on here, which is that with private banks, almost 73% loans are on EBLR. With foreign banks, it's at 84%. But with government banks, it's still only 36%, and that's dragging down the industry average to about 40, 49, 50%. So a lot needs to change with the outstanding government bank loans. I think there was a phase where people were reluctant to move on from MCLR to EBLR because they probably had very high reset periods, maybe 12 months, and they got through that period of 12 months, the last 12 months, without any significant rate hikes. So they would have thought that, okay, MCLR is better in this situation because my rate will not change for another year. But now, as interest rates seem to be peaking, they'll be stuck with these high rates for another 12 months. So it cuts both ways with MCLR as well.
So, Hemant, now for all the loan borrowers who have their loans attached with MCLR, do you think going ahead, whenever the times come for the resetting of their loan, it makes sense to approach the bank and ask for an external benchmark lending rate?
Yeah, I think you should. The first question you need to ask is how much you're paying over and above prevalent market rates. So, to the ideal borrower with a good credit score, with stable income, the lowest rate that they can get right now is 8.4, 8.5, right? If you have a credit score of 800, you have stable income, and if you're paying, let's say, 9.5%, you should question that, right? You're paying well above the market rate, well above what you should be paying. So you should 100% consider a refinance of some kind. And there are only two questions to ask from that point, which is that should you stay on with your lender or move to another lender? If you are with a bank, you can easily refinance from an MCLR loan or a base rate loan to a repo linked loan. It's normally, it involves paying a small processing fee and minimal paperwork. If you are thinking of transferring your balance to another lender, it will require a little more paperwork, slightly higher costs as well. But if the difference is 50 basis points or 100 basis points, you'll easily recover that in a very short span of time. And once the rates start to fall and those rate cuts will be passed on to you immediately, you will recover whatever cost you had put into that refinance. Kavita.
All right, I think, Hemant, that will be all for today. Thank you so much for being on the show and helping our viewers with basic difference between MCLR and EBLR. Thank you so much. We move on and we'll take a quick break. Post that, let's get your queries answered by Feroz Aziz. And also, how can you have a zero debt portfolio and what would be the investment strategies for senior citizens on World Senior Citizen Day? All of this and more after this break with Feroz Aziz.